Hi friends, myself Subrata Mukherjee and you are watching my channel Dr. Subrata Mukherjee Distance Learning in Commerce. Today I am going to discuss another problem on insurance claim for loss of stock. This is lecture number 5 and you can see the other lectures in the playlist section of the channel. I would like to request my viewers to subscribe my channel and to browse the playlist section of the channel where I have uploaded lectures on accounts, costing, financial management and management accounting. I would like to request the students to write the question and the solution and try to follow the way I have done it here. If you find any difficulty in understanding, feel free to contact me through email and the contact number that I have given in the description box. A fire occurred in the business premises of a concern on 30th June 2003. From the following figures, calculate the amount of claim for loss of stock with the insurance company. Stock at cost on 1st January 2002, 1,35,000. Stock at cost on 1st January 2003, 1,50,000. Purchases during 2002, 9,15,000. Purchases from 1st January 2003 to 30th June 2003, 9 lakh. Sales during 2002, 12 lakh. Sales from 1st January 2003 to 30th June 2003, 9,90,000. You are informed that in 2003, the costs of purchase have risen by 20% above the level prevailing in 2002. In 2003, the selling prices have gone up by 10% over the level prevailing in 2002. Salvage value of stock, rupees 20,000. Fire insurance policy for rupees 1,48,750 to cover the loss of stock by fire. First of all, we need to prepare the trading account for the year ended 31st December 2002. So here I am writing trading account for the year ended 31st December 2002. So to opening stock 1,35,000. To purchase, so the amount of purchases during 2002 is 9,15,000. The sales during 2002 is 12 lakh rupees. And the closing stock 31st December 2002 is given as 1,50,000. So you will get a gross profit of rupees 3 lakh in 2002. So total of debit and credit side is 13,50,000. So we need to prepare the trading account for the previous year in order to determine the GP rate, that is the gross profit rate. So gross profit rate for the previous year is 3 lakh by 12 lakh into 100 is 25%. So we computed the gross profit rate for the previous year at 25%. Here we have to prepare the trading account from the first day of the current year till the date when the fire took place. In the question it is given that the sales price have risen by 10% over 2002 and the purchase price have risen by 20% over 2002. So we have to prepare the trading account for 6 months, that is from the first day of the current year till the date of fire at two prices, at 2002 price and at actual. So let us proceed. So I have prepared the structure for the trading account for the period from 1st January 2003 to 30th June 2003. So on the debit side, I have written at actuals, that is the actual price and at last year's price. And on credit side also, I have written at actuals and at last year's price. So the opening stock is the closing stock of the previous year. So the opening stock I can write here at 1,50,000. Next is purchase. So it is given in the question that the purchase for the period from 1st January 2003 to 30th June 2003 is given at rupees 9 lakh. It is given in the question that the purchase price in 2003 has risen by 20%. So what is the purchase if it was at last year's price? So this amount will be 9 lakh into 100 by 120. So you will get 7,50,000. So if the price would have not risen, then the purchase cost would have been 7,50,000. Since there is an increase in the price by 20%, so the purchase cost for the current year is 9 lakh. So you can also calculate 7,50,000 into 120%, you will get 9 lakh. Now sales during this period is given at 9,90,000. So this is the actual sales for the period from 1st January 2003 to 30th June 2003. Now it is given that the sales price has risen by 10%. So what is the sales at last year's price? So 9,90,000, multiply it by 100 and divide it by 110, you will get 9 lakh. So if there was no increase in the sales price, then the sales during this period would have been 9 lakh. Since there is an increase in the sales price by 10%, so the actual sales during this period is 9,90,000. Now we have calculated the gross profit rate at 25% at last year's price. So why we are calculating these two columns, that is at actuals and at last year's price? Because we have to calculate what is the gross profit at last year's price. So I can write here to GP. So 9 lakh is the sales at last year's price that we have computed here. If you multiply it by the GP percent of 25%, you will get the gross profit at last year's price would have been 2,25,000. And you can easily calculate the value of closing stock at last year's price. So as a balancing figure. So total of the debit side is 11,25,000. And the closing stock at last year's price will be 2,25,000. Now, what will be the closing stock, value of the closing stock at current year price? This will be 2,25,000 multiply with 120% because there is a rise in the purchase cost by 20%. So, the closing stock at the current price will be 2,70,000. So you will get the gross profit 12,60,000 is the total of the credit side, and the gross profit will be 2,10,000. So the value of closing stock on the date of fire will be 2,70,000. Now we will calculate what is the gross claim and the net claim. So estimated value of stock on 30th June 2003 is rupees 2,70,000 less salvage 20,000 and your gross claim is rupees 2,50,000, and this 2,50,000 is subject to average clause. So net claim will be equal to 2,50,000. Multiply this with the value of policy taken, which is rupees 1,48,750, and divide it with the estimated stock on the date of fire, that is 2,70,000, and your net claim is rupees 1,37,731. Hope all the students have recorded the solution and have followed the process. I have followed it here. If you find any difficulty in understanding, feel free to contact me through email and the contact number given in the description box. Thank you. Thanks for watching the lecture.